Something you need to know. As stock prices have risen, so has inequality. The stock market has grown over 3,000% over the last 40 years, seen as a place to create wealth and prosperity for the average person. So why, when the stock market has risen, so has inequality?
Inequality is on the rise.
Homelessness has jumped 16% in a year.
There's a pretty simple reason why the rich got richer during the pandemic. It's the stock market.
The stock market is said to be an indicator of the health of the economy. When the stock market is doing well, so is the economy. But what are stocks? And what's the economy got to do with it? And why should you even care about the stock market?
New York Stock Exchange. We like the stock. We like the stock.
The Dow plummeting more than 1,000 points.
We're down over 16%.
Dow Jones Industrial Average just hit 30,000, which is the highest in history.
Today, the Dow dropped more than 500 points.
What are stocks? A stock is a form of security, indicating the holder has some sort of ownership in the company that issued it, and securities are used as a financial instrument to raise cash or money. So why would someone offer shares or stocks? Let's say someone wants to expand by opening more stores. This requires money, the cost of renting a store, hiring workers, inventory, and so on. They could take a loan from the bank, but the burden of interest payments and loan repayments can be risky. This is where shares come in. Let's say a person owns 100% of the company and the company is valued at $100,000. They could sell ownership in the company for money through shares, with each share representing a certain amount of ownership. They may decide to sell, say, 10%. This can be issued in a stock in many different ways. For example, one share can represent 10% in the company, or one share can represent 1%. This can be done privately, where shares are only available for certain people, such as friends and rich investors. Or this can be done publicly, where anyone is able to buy shares in the company. This would be done on the stock market, through something known as the IPO, standing for Initial Public Offering, where a set amount of stocks are issued into the public markets, normally the stock market. The initial shares available in the public markets are known as the float amount. The stock market is basically in the name, a market where goods can be bought and sold, the goods being stocks. And there are many different stock markets, the oldest being the New York Stock Exchange and then the Nasdaq, the two biggest in the US. Other countries also have their own stock markets.
On the London Stock Exchange,
Tokyo Stock Exchange.
Shanghai Exchange.
So when having an IPO, you can choose which market people will be able to buy and sell your stocks in.
The largest IPOs in history.
Uber has priced its IPO at $45 per share.
Airbnb going public today in one of the most anticipated IPOs of the year.
Got the lift IPO news.
The stock market connects people who want to buy stocks to people who are selling stocks, where people post a price where they are willing to sell or buy a stock at. And when buying stocks, there are two types of orders. One being a market order, where stocks are bought or sold at the market price. If buying, the cheapest listed stock is bought, and if selling, it's sold to the highest bidder. The other order type is the limit order, where you determine the specific price you want to buy or sell a stock at. To buy or sell stocks, you must have an account with the stock exchange, but this is not accessible to everyone due to the requirements for needing an account being quite stringent. So you have to go through something called a brokerage. They have an account with whatever specific stock market you're trying to buy the stock from and will conduct the trade on your behalf. You've probably seen clips where there are many people rushing and shouting on a trading floor, where brokers would have to manually conduct trades for their clients. But now, this is all done electronically, and there are many brokerages which now give easy access to stocks for most people. There is simple buying and selling stocks, and then there are derivatives, which is a contract which derives its value from an underlying asset. Let me explain. Derivatives are mostly used as a way to speculate on the stock market. Its actual use is to help increase the efficiency of the stock market, as they lower the unforeseen costs of purchasing an asset outright. The most popular derivatives are options and futures. A warning needs to be made. These type of investing methods are very risky and should be approached with caution, as there is a very high risk of losing all your money. Options are basically contracts which give you the right, but not the obligation, to buy or sell a certain stock at a future date, and the contract represents the right to buy or sell 100 shares. There are two types of options, puts and calls. Call options give you the option to buy a stock at an agreed upon price in the future, while put options allow you to sell a stock at an agreed upon price in the future. The agreed upon price is known as the strike price. A small premium also must be paid for being able to purchase these option contracts. This may all seem confusing, but let me explain with an example. Let's say Apple shares are trading at $100. Let's start with call options. You want to buy an Apple call option as you believe the price will increase in the future. You see a call option contract for Apple shares with a strike price of $105 and has an expiration date in a month's time with a premium of $1 per share. If you decide to purchase this option contract, it means you have to pay a premium, which is $1 per share. And as option contracts represent 100 shares, the premium would be $100. This means any time between the date the option contract is written and the expiration date, you have the right to purchase 100 Apple shares at $105 from the writer of the contract. If a month goes by and the Apple shares are trading at, let's say, $115, it means the option is in the money, as the market price is trading above the strike price of $105, meaning you can, if wanted, to purchase the shares at $105 and sell it on the open market for $115, making a nice profit. If the share price was $95 after a month, you can just let the contract expire and all you lose is the premium. You can also sell call option contracts. Here all you would do is create a contract, choosing the strike price of a certain share and the expiration date of the contract and the premium for being able to purchase the contract. This is done in the hope the strike price of the contract is not reached, meaning the person who purchased the option contract will let it expire, meaning you get to keep the premium and you don't have to sell your shares, as the person wouldn't activate the options contract, as it would be cheaper to purchase the stocks on the open market. If you believe the price will go down, it's the opposite. You can get a put option. It's similar to call options, which list the strike price, the expiration date, and the premium. The only difference here is the strike price determines at what price you can sell your shares to the writer of the options contract for. Let's use the previous example of Apple shares trading at $100. If the strike price of the contract is $90 per share, and you believe the price of the share will be lower than that near the expiration date, you can purchase the put option, and if near the expiration of the contract, the share price reaches $75, it means the contract is in the money, as the market price is lower than the strike price. So you can sell your stocks to the contract writer for $90, either by having your own pre-existing stocks or buying them on the open market for $75 and then selling them to the contract writer for $90, making a nice profit. If the price of the stock does not go below the strike price, all you lose is the premium. The other type of derivatives are futures. They are similar to options, but much more straightforward. It's a contract where there's an agreed upon set price to buy or sell a certain amount of stocks at a certain time in the future, and you have to honor the agreement. So if you believe a stock price is going up, you agree to buy a set amount of stocks in the future at the current price today. If you believe the stock price is going down, you agree to sell the stock at the current price today in the future. An important thing to know is how the value of stocks are determined, which would be simple supply and demand, which would reflect the actual value of companies. However, the stock market runs on narratives. It's not the actual value of the company that determines its stock price, but what the most popular narrative people believe about the company, with most stocks just reflecting what the collective sentiment about the company is. The most basic being a company reporting good quarterly earnings or decisions companies take, which are seen as good in the eyes of the shareholder, but also stories which can tarnish the reputation of a company, can reduce the stock price.
Facebook Cambridge Analytica scandal.
Goldman Sachs agreeing to pay an additional $2.6 billion in fines for the 1MDB scandal to regulators.
Sometimes narratives can be complete hype and have nothing to do with the actual value of the company, as seen with the dot-com bubble. This was a time where internet companies were seen as the next big thing, and this sentiment led to money being recklessly thrown at them.
NASDAQ 5000, America's favorite stock index, closed above 5K for the first time today.
The internet stock craze.
The stock trading at 5 times its offering price.
What the stock did, up 482%.
Which only traded one day, gained 606% on the week.
They are counting up the damage on Wall Street.
Points drop never before seen on the US markets.
Huge stock market falls. The biggest losses were in the technology and internet stocks.
The worst hit shares have been the technology stocks, including the dot-com companies, culminating in a record one-day fall of 616 points.
The question of why you should invest in the stock market is simple. It's to make money. This happens through two ways. Either through the price of your stock increasing or getting paid in dividends. Dividends are basically payments from the company to shareholders, which come from the profit the company makes. And the more stocks you hold, the bigger the payment. The market is a place to make money, and in a place with this amount of money, there will always be big players. There are two types of investors: institutional investors and retail investors. Institutional investors are big pension funds, hedge funds, investment banks who manage a lot of money and invest in the stock market. And then there are retail investors, the everyday normal person, me, you, or anyone that invests in the stock market. And the basic strategy of the stock market is to buy low and sell high. This can be done through short-term trading, where stock is bought and sold over a day, week, or a month, meaning the price is sensitive to market forces. These different market forces can be anything from false stories about the company to increases in supply chain costs, to new legislation or interest rates being changed. The ability to react to these market forces in the short term for the retail investor is difficult. However, these market forces don't play such a big role in the long term. Long-term investing is investing for years or decades, as when you are investing over a longer period, you overcome all the noise and the fluff, as you are in it for the long haul, meaning you aren't affected by short-term volatility. If you look at the stock market over its inception, the market has always bounced back after a crash and to higher peaks. A recent example being when coronavirus and lockdowns were announced. Many people sold and the stock market crashed. However, it recovered shortly after, and if you had the mindset of a long-term investor, this wouldn't have affected you.
An economic shock of unknowable scale is upon us, and shares in companies are being sold off.
Investing long-term is good and all, but what stocks should you buy? I'm sure you've heard of the term value investing, coined by Benjamin Graham and popularized by Warren Buffett. This is where you make careful analysis of a company, looking at its balance sheet, its business model, and how it's run. But what if you don't want the hassle of doing all that research? This is where indexes come in. They track the performance of a group of assets in a standardized way. For example, the S&P 500, which tracks the top 500 companies in the US.
S&P 500 jumping to a new all-time high.
Seen in the S&P 500.
For the S&P 500.
Or in the UK, the FTSE 100, or Germany's DAX index. These indexes are used to measure how the stock market is doing as a whole, as they contain the biggest companies who normally account for most of the capital and trading in whichever specific stock market they are listed in. And these indexes have been turned into funds, which you can invest in. There are two types of funds, either an index fund or an ETF, which stands for Exchange Traded Fund. They are very similar, but there's a small difference. Index funds can only be traded at a set price, which happens at the end of the trading day, while ETFs can be traded throughout the day, like a normal stock. If you were to buy an S&P 500 ETF, you would be buying a small percent of all the 500 companies the S&P 500 tracks as one share. These funds mitigate risk due to the amount of stocks in them, meaning if one company were to fail, it would not have an impact on the fund as a whole. Because these funds exist, means you don't have to go through the process of buying all the individual stocks yourself. The only question that remains is, when should you buy these stocks? The best piece of advice for the average investor is dollar cost averaging. This is where you invest a fixed amount each month, regardless of how the market is performing, meaning the investment is not subject to as much volatility, as the price will likely vary each time you invest. This is the number one rule of the stock market. You can never time the market, as there are so many factors that you cannot predict. Even Warren Buffett, the most famous investor, lets it be known,
we haven't the faintest idea what the stock market is going to do.
The stock market is a place to generate wealth, and a place which can be used for good, as when companies have shares issued publicly, it encourages them to work for what is the best for the shareholder. As if bad decisions are made by the company, it would lead to shareholders selling their shares, reducing the price of the stock. The stock market is normally seen as an indicator of the health of the economy. The better the stock market is doing, the better the economy is doing, as a lot of companies publicly listed on the stock market make up a large chunk of a country's economy due to the people they employ, business dealings, and transactions they do in the economy. However, as stock prices have risen over the years, growth in the real economy and wages have not risen comparatively. It can be put down to a shift in the way companies are run. Companies were initially seen as public institutions, looking out for interests of all parties involved: employees, suppliers, shareholders, and communities, meaning decisions would be made in tandem for the whole. But this sentiment slowly began changing, from looking out for everyone's interests to only looking out for shareholders' interests, which is to increase the stock price. And the need to increase stock price meant that companies would make decisions which would negatively affect public interests. Short-term decisions, such as reducing costs. This would be done through offloading employees, not investing much in research and development, and reducing the quality of products, all things which are bad for the economy. This extra money would be paid to shareholders through dividends or through stock buybacks, where companies would purchase their shares back from the stock market. A tactic used to increase share price by decreasing the supply of stocks artificially, and over the last few years, this is how most companies have spent their earnings, on stock buybacks and dividends. This type of short-term behavior is encouraged, as CEO pay packages are normally tied to stock price performance, meaning the higher the stock price goes, the more money the CEO makes, incentivizing CEOs to make short-term decisions which raise stock prices. These practices are not good for the economy or public interest, as companies cannot focus on things that lead to long-term success and economic growth, as stock price is the main focus. Boeing is a classic example of this. Once regarded as an institution for engineering quality aircrafts, a reputation built over decades.
Good evening, everyone. It is a multi-billion-dollar deal that is sending shockwaves through the aerospace industry. The planned merger between the Boeing company and McDonnell Douglas.
After new management was put in charge, a need to increase share price became the main target, leading to many bad decisions, such as reducing costs, through laying people off and rushing out products. This increased the stock price in the short term, but led to long-term problems for a company once seen as a national treasure.
Now to the major story unfolding overseas, a Boeing 737 passenger jet crashing off Indonesia.
Our breaking news, an Ethiopian Airlines flight has crashed shortly after takeoff from Addis Ababa. The Boeing 737 MAX was heading to the Kenyan capital, Nairobi.
We're going to be issuing an emergency order of prohibition to ground all flights of the 737 MAX 8 and the 737 MAX 9.
Boeing shares dropping sharply this morning. Boeing shares right now down by 6.3%.
Employee emails and texts released by Boeing to Congress paint a deeply disturbing picture of how the company sought to mislead federal regulators about the safety of its embattled 737 MAX jetliner.
Prosecutors have just charged the company's former chief technical pilot about lying to regulators and airlines about the plane's flight control system.
The world of stocks and investing can be confusing and scary. It can seem like there's so much to know, but keeping it stupid simple, especially when it comes to stocks, is good advice. Meaning simplicity and patience are probably the most important traits you can have when deciding to invest in stocks. Obviously, you should do your own research to get a general understanding of stocks and investing so you can navigate this world and understand yourself what you are getting into. Stocks and investing play a big part in everyone's lives, whether you have a direct interest in it or the effects it can have on you through the economy. So knowing a little goes a long way. That's the end of the video. I hope you enjoyed it. This is the first part of a two-part series on the stock market, and in the second part I'll be going over the controversies and how Wall Street runs the stock market. So anyways, that's it. Hope you guys enjoyed the video and see you guys next time.